The game Wall Street plays is a game of acceleration, deceleration. Wall Street likes to see when the numbers are getting stronger and stronger and stronger and stronger, and then they get scared and they kind of flood out if things are getting weaker. So Meta just grew revenue 27% year over year, but then next quarter they might only grow revenue, let's call it 18%. And so Wall Street does not like that, right? I think the biggest thing actually I took away from Meta earnings is it's impossible to not be a bit bullish on Nvidia. I mean, when you look at what Elon was talking about last night in the conference call, specifically mentioning H100, specifically mentioning Nvidia, specifically mentioned how many chips he hopes to have by the end of the year. When you hear Meta talking about big CapEx spend for the next several years, it all comes back to Nvidia. Hello, everybody. Hello, chat. Hope you guys are doing great. We got a busy live stream here today. We got Meta earnings on deck. We got Chipotle earnings on deck. We got to get these vibes right for this Meta earnings. A lot of money riding today. A lot of money.
All right, Julia Borston. Meta, and Meta. What should we expect?
Meta.
Meta shares are up 40% year to date, and revenue at the company is expected to continue to accelerate its growth rate. The top line is projected
there we
to
go.
by 26%.
I like those flapjacks. Flip them, baby.
The number one key
Flip
number
them.
to watch.
Flip them,
96%
flapjacks.
growth in
Love
earnings
it.
per share. Now, all of that growth is expected to come from tailwinds, from Reels, from AI driving results for advertisers, a solid digital ad market, as well as perhaps some early revenue from the messaging business. Now, analysts are very overwhelmingly bullish. 86% have a buy or overweight rating on the stock, 11% have a hold. So we'll have to see if Meta says anything about more benefits to come from AI or how it could benefit from a TikTok ban. Back over to you.
All right, Julia, we'll see you in OT. I mean, Mike, you can't possibly keep up the sales growth pace. The question is, how much do you have to?
Exactly. And as this year goes on, it's going to be interesting because growth is stepping down from monstrously high rates. 70% EPS growth last year for Meta. It's supposed to be 35 this year. 2025 is supposed to be 15% growth. So it's a matter of what you pay for that. I mean, you're less than 25 times next year's earnings.
Oh, 700 after hours. Don't get me freaking excited like that.
Teens or at least double digit.
If I see 700 after hours,
a little bit of a window on their clarity on those growth rates.
Yeah,
I might lose my mind.
Really, K. Rogers
700. Don't even get me excited like that.
It's I think a highly owned name. What do we expect there?
So, Scott, analysts are looking for EPS of $11.68 on revenues of $2.67 billion for the quarter. Same-store sales are expected to increase 5.2%. That metric will really be key for analysts, as well as any commentary around consumer sentiment and pricing power, which Chipotle has really maintained here, even in the face of some pullback from lower-end consumers at some of its competitors. Another thing we're going to be looking out for, traffic growth. Chipotle saw traffic increase by more than 7% last quarter. That bucks an industry trend of falling traffic in this competitive environment. So far this year, you mentioned Chipotle's among the best performers in the restaurant sector. It's up nearly 30%, and CEO Brian Niccol will join us exclusively before the analyst call in overtime.
Yeah, of course he will, that freaking Taco Bell stock pumper. So after hours here, obviously all eyes are going to be on Meta, the Meta numbers. We will also listen to a conference call live with Zuckerberg here after hours as well. But also IBM, Ford, and Chipotle report, and ServiceNow, which is actually a decent-sized market cap, now at this point in time also reporting after hours, so it should be busy. The milestones, kind of what we're looking at here, we really want to see Meta come in with a 5. If Meta comes in with a 5, watch out. 575 quick on this stock, okay? A 5 number, woo! Also, if for any reason revenue growth hits a 3, something 30-something%, and then they guide for a 20 plus next quarter, 575, get out of our way. We're coming for you, baby. Okay? So those are some numbers to kind of keep in mind there. I like the valuation going in these earnings. We're at about a 24 forward P. Assuming analysts are correct with where they're at, they're probably too low with their EPS estimates for Meta for the next year. So yeah, looking really good. 1000xstocks.com if you want to apply. That is my service there. It's pretty darn phenomenal. Alrighty, so let's get rolling here.
Meta and ServiceNow. These are two names.
What in the hell?
AI plays. What on ServiceNow? Because we talked about Meta.
Oh,
I'm really curious.
Oh, come on, Meta.
Let's get those Meta results, Julia Boyd.
Oh, stop it.
That's right. Meta beating expectations on both the top and bottom lines. Revenue coming in at $36.46 billion, ahead of expectations of $36.16 billion. Earnings of $4.71 a share, ahead of estimates of $4.32 a share. But we see the stock trading lower now, and that appears to be on the company's revenue guidance for the second quarter. It's $36.5 billion to $39 billion. That revenue guidance with a midpoint of $37.75 billion is slightly below expectations of $38.29 billion. Also, another factor weighing on the stock, now down 10% in after-hour trading, the company's total expense range. Meta is raising the bottom end of its total expense range for the year to now $96 to $99 billion.
That's bullish for Nvidia.
Previously
bullish
$94 billion.
Nvidia.
Company also increasing its capex outlook for the year. The range was $30
bullish
to $37
Nvidia.
billion. Now they're increasing that range
Very
to between
bullish
$35
Nvidia.
billion and $40 billion. Just a couple other key things here as we see the stock is trading down on those higher expenses. The company's operating margin of 38% does appear to be above analyst estimates. Daily active people, that's the people using at least one of Meta's apps daily, that did increase 7% year over year. And then Reality Labs, the losses in that division to $3.8 billion, that's less than the losses of $3.9 billion in the year-ago quarter, and also less than the losses of $4.3 billion that was expected. But it does seem like those higher expenses are weighing on the stock right now. Back over to you.
Higher expenses, Victoria, and weaker revenue, at least at the midpoint. Has Mark Zuckerberg at this point earned the right to spend this much money as long as it's not on the metaverse?
Yeah, Reality Labs, I think that black hole, we're getting a little tired. We'd like to see a little less burn in there. And the CapEx is a little bit concerning. They've done such a great job the year of efficiency.
Well, the folks on the sideline get a nice buy the dip opportunity here. Let's go through these numbers here. Revenue up 27%, which is insanely impressive, because you're not going to see those numbers out of any of their competitors when it comes to ad growth there. Cost and expenses was only up 6%. Income from operations up 91% year over year. Are you flipping my flapjacks here? Operating margin went to 38% from 25%. Oh my gosh, these numbers are great. Effective tax rate, somehow they got that down massively. I don't know what trick they pulled out of the rabbit there. Net income up 117% year over year. Net income $12.3 billion versus $5.7 billion in the same quarter last year. Diluted EPS $4.71 versus $2.20. It's 114% growth. You'll be flipping my flapjacks. Daily active people increased 7% year over year. That's phenomenal. I don't even know how they can still grow. I'll be honest. I mean, over 3 billion people using one of their products on a daily basis. Ad impressions delivered across a family of apps increased 20% year over year. Average price per ad was up 6% year over year. Revenue on constant currency basis, 36.46, 36. So respectively, 27%. Cost and expenses only increased 6%. That's like nothing. CapEx, $6.72 billion. Capital return program, shares repurchased. Wow, they repurchased over $14 billion of the stock and then paid out a $1.27 billion dividend, which I do appreciate. Cash and cash equivalents, 58 plus marketable securities, $58 billion. Free cash flow, over $12 billion. These numbers are phenomenal. Headcount was down 10% year over year. So the headcount's down 10%, but the revenue's up 27%. The guide, they're talking about 36.5 to 39 billion. So we can say that's a midpoint of, 37.75, right? 37.75 midpoint. 37.75 midpoint. So slightly under where analysts are at, because analysts were at 38.3. So 37.75, so about $500 million off there of the midpoint, correct? So that's something to factor in there, right? We expect full year 2024 total expenses to be in the range of 96 to 99 billion, updated from the prior outlook of 99 or 94 to 99. So now they're going to spend more on the high end of the range, right? Due to higher infrastructure and legal costs for Reality Labs, we continue to expect operating losses to increase meaningfully year over year due to ongoing product development efforts and investment focus on scale of our ecosystem. So it's bullish for Nvidia at the end of the day, in my opinion there. We anticipate our full year 2024 CapEx to be in the range of $35 to $40 billion, increase from our prior range of 30 to 37, as we continue to accelerate our infrastructure investments to support our artificial intelligence roadmap. We're going to spend as much as we flip and flapjack and can with Nvidia, basically. That's what it sounds like to me. While we are not providing guidance for years beyond 2024, we expect CapEx will continue to increase next year as we invest aggressively to support our ambitious AI research and product development efforts. So that might be something Wall Street's looking at as a negative. You know, if I'm trying to poke holes at what's negative here, right? $500 million, the midpoint off of where analysts were at for next quarter for revenue. Okay. Now, when you're doing, nearly $40 billion of revenue, it's actually a very small percentage, right? But still $500 million there, right? They're going to spend, let's call it at the high end of their range rather than the low end of their range when it comes to CapEx. So, and when it comes to total expenses for the business. So if you want to poke holes at something negative, you could poke it at that. Now also, Zuckerberg's basically saying here, we expect CapEx to continue to increase next year as we invest aggressively to support our ambitious AI research and product development efforts. So that's another just fancy way of saying, we're going to be spending a lot of money. And Wall Street might not like that. Wall Street gets very concerned about Zuckerberg spending sometimes. Actually, a lot of the time. They don't like it when Zuckerberg says we're going to spend. They like it when he's talking about efficiency, right? In addition, we continue to monitor an active regulatory landscape, including increasing legal and regulatory headwinds in the European Union and the United States that could significantly impact our business and our financial results. Q1 was a good start to the year. We're seeing strong momentum within our family of apps and making important progress on our longer-term AI and Reality Labs initiatives that have the potential to transform the way people interact with our services over the coming years. Okay. So the numbers are pretty phenomenal, obviously. I mean, when you've got net income up 100+% year over year and you got your revenue up 27%, that's pretty darn impressive. Balance sheet's looking great, which Meta always has a great balance sheet here. So we'll see what they say in the conference call. The conference call will matter significantly here. But from the numbers look absolutely phenomenal. Yeah, I mean, there's really, even if you're the most bearish person in the world on Meta, there's really nothing negative you can say about these numbers. Revenue up 27%, cost and expenses up 6%, income from operations up 91%, net income up 117%, diluted EPS up 114% like this. And here's the thing with Meta. It's not like it's trading at a high valuation. That's why I say if this stock's down at all tomorrow, it's just the biggest gift. The biggest gift. If it went in and it was trading at a 50 forward PE or 60 or 70 or something like that, okay, then it's like, okay, I can understand it giving back some because, it was priced to perfection. It had to get everything perfect. But this sort of opportunity, I don't know. So Meta just came through a 27% revenue growth. So that's the strongest revenue growth the company's come through with since September 2021. So obviously during the Rona period, the growth was kind of insane during that time. 33%, 47%, 55%, 35%, right? But then if you go back prior to Rona, the last time they grew 27% or more would have been September 2019 at a 28% clip, 27%. This was back in the day when Meta was like insane growth and they were posting like 40, 50% growth quarter in and quarter out back in those years. So pretty phenomenal numbers. But the issue, once again, is we're going from a situation where the growth is accelerating to now decelerating, right? Because basically it sounds like where Meta's guiding at, they're expecting revenue to be up about we can call it, let's say, 18% year over year, which is still very impressive, by the way, right? As a long-term investor, you got to kind of differentiate this whole game, the whole Wall Street game of like analysts and, Wall Street and expectations and all this baloney. At the end of the day, is your company growing very nicely? Are they making more money and those sorts of things, right? But the game Wall Street plays is a game of acceleration, deceleration. Wall Street likes to see when the numbers are getting stronger and stronger and stronger and stronger, and then they get scared and they kind of flood out if things are getting weaker. So Meta just grew revenue 27% year over year, but then next quarter they might only grow revenue, let's call it 18%. And so Wall Street does not like that, right? Because then they start thinking, oh, what's the following quarter? 14% growth. And what's the following quarter? 10% growth. And so, because that's what happened here, for instance, right? You look at the company, they were growing, 55% growth there at the peak, June 30th, 2021 quarter. Then they went down to 35%, then 19%, then 6%. Then they actually had revenue go down, right? Which is really extreme. And then, guess what? We bottom right here as far as revenue, and things get better and better. 2% growth, 11% growth, 23% growth, 24% growth, and this most recent quarter, 27% growth, right? So a little food for thought in regards to that. Let's hear what this guy has to say.
Results. Julia Borston just spoke with the company's CFO. Julia?
That's right, John. I just spoke to Meta CFO Susan Li, asked her about some of those factors that are weighing on the stock. She explained the higher infrastructure expense guidance that Meta gave for the year, saying that this guidance reflects larger than planned investments in core AI work. A lot of that is going towards GPUs, but also towards data centers. She said that the company raising its total expense guidance is partially due to higher legal-related expenses as well as higher infrastructure expenses. Now then, in terms of the light second quarter revenue guidance, I asked about that. Lee said, quote, "We're continuing to see healthy ad demand and engagement trends, but our outlook is reflecting that we're lapping a period of stronger demand, particularly from China-based advertisers." She said that in the first quarter, their growth was really driven by ongoing ad performance improvements as well as Reels, and that they did see brand campaigns recover from October softness.
This is
now,
extreme. Nvidia should be up huge after hours. It should be.
Lee said that their investments in AI are continuing to pay off.
Nvidia should be up huge after hours. Meta just basically said we're going to spend a lot more with Nvidia without saying that, right? If you just read through the tea tree leaves, they basically put the pieces together. They're basically saying they're going to spend a lot more money with Nvidia than they thought. Elon Musk on the conference call was talking about Nvidia. He's talking about he thinks they can have 85,000 H100s by the end of this year. Right now they have 35,000, right? Which means he thinks they can take delivery of another 50,000 H100s by the end of this year, which means they're going to have, order way more than what they've ordered in the past. So all this ends up coming back to Nvidia at the end of the day. And so the pieces of puzzle are there. Like Nvidia stock should be up huge.
Improvement to their ad business, but it's concerns about that guidance.
People don't always
put
the piece of puzzle together.
That's
right?
weighing on results. Weighing on the stock, now down about 11.5% or 12% in after-hours trading. Morgan.
All right, Julia, some great context there. Thanks for bringing it to us. For more on Meta, let's bring in Citizens JMP research analyst Andrew Booth. He has an outperform rating on Meta, $550 price target. Called it his top advertising idea into earnings. Let's start right there because stock's under pressure. It's down 12%. They're spending more money on AI, infrastructure, GPUs. You just heard about it. But it also sounds like from the CFO, Susan Li, some pretty upbeat commentary, albeit some hard comps, but some upbeat commentary around digital advertising. What do you make of it?
AI is definitely an investment area, and I also think it's a driver of growth. Reels is still contributing, and then if you look at Meta AI, which is their recently released AI assistant on the platform, there's a real opportunity for Meta to be able to take share of other budgets, meaning search going forward. In combination, we think that growth can sustain itself in the back half of 24 and then into 25.
Okay. So in light of that, especially the commentary about the Chinese e-commerce companies and lapping tough comparisons there. I mean, we know the U.S. government is scrutinizing some of this industry. How much of a risk is that to Meta at a time where they are seeing these green shoots in terms of digital advertising growth overall?
Yeah, I mean, there are puts and takes there. Certainly a TikTok ban would be beneficial to Meta, right? You see a bunch of users that would probably flock to Instagram, while a ban on Shein or Temu would certainly be a negative in terms of reducing what are two major advertisers on the platform. And so, the devil is in the detail on these. I think net China, though, has the potential to continue to be a tailwind as you still see more manufacturers want to reach U.S. consumers.
Andrew, how much runway do you think Meta has, particularly with Reels ads? I'm just starting to see them appear more and more. And,
you'll see a lot more of those.
I know that Reels is also different because, and Zuckerberg has talked about this a bit, they're not showing those ads to you based on who you're connected to. They're really using more AI, kind of TikTok style, to figure out what you're uniquely going to be interested in. Is this a long-term, brand new revenue source that you're measuring yet, or no?
I think there are two really interesting points there. One of which is that Reels has the opportunity to take linear TV dollars. Linear TV remains the largest kind of offline bucket of ad spend that's still available. The shift to digital properties. That's one point. And then you're right. I think there is better contextual advertising that will be available as Reels continues to work on their algorithms and make everything more personalized, including ads.
All right. After hours, overtime session lows now for Meta, now down a little bit more than 12%. Andrew, thank you.
I think the last 24 hours has been a good example of the game of the stock market. I guess that's the best way I can describe it. The game of the stock market, right? Because you look at Tesla's numbers, right? The numbers were obviously extremely disappointing. Net income down, 50% plus year over year. Like, we all know the numbers. We went over them all, right? Extremely disappointing. But stock blasted higher on really bad numbers. But the stock had been a very devastated stock, right? Then you go to Meta. Meta reports these unbelievable numbers, 27% revenue growth. They report over 100% net income growth, over 100% EPS growth. I mean, just is as good as it gets. And the stock goes down, right? But Meta stock's been up significantly. And so there could be a view that Meta's business model in the short term is slowly declining in terms of growth rates, right? Doesn't mean declining as in revenue is going negative. It just means in terms of like the exciting part. It's a flawed way of investing, but it's how Wall Street operates. And so it's very important we all as investors kind of differentiate between the game of Wall Street and actually investing, right? Because actual investing has nothing to do with this game of, oh, did they beat the numbers? Did they miss the numbers? Oh, was everything already priced in? All these little games that are played, right? Oh, is it priced in? Oh, was Meta's great numbers already priced in? Was Tesla's numbers already priced in? Like, that at the end of the day, the long-term mindset wins, right? But, you just have to deal with the short-term games that are played. At the end of the day, next quarter, Meta's going to have tremendous revenue growth again, right? Is it 27%? No. It might be 18%, 17%, 19%. But that's still incredibly strong. Meta's net income next quarter is going to be off the charts again. Is it going to be over 100% growth? No. But maybe it's 50, 60, 70% growth year over year, right? Which, when you look at it and just step back a little bit and you say, okay, this company next quarter might grow revenue 18%, let's say, and let's say they grow earnings per share 50%. We'll just throw that number out there, okay? Well, when you're paying a forward P in the 20s, let's call it low 20s, for a company that has those sorts of growth rates, if you know anything about valuation, that's a steal deal. And so we'll play the game of Wall Street. They want to play that game, they can play that game. But as investors, we just got to differentiate that.
Thank you. Good afternoon and welcome to Meta Platforms' first quarter 2024 earnings conference call. Joining me today to discuss our results are Mark Zuckerberg, CEO, and Susan Li, CFO. Before we get started, I would like to take this opportunity to remind you that our remarks today will include forward-looking statements. Actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are set forth in today's earnings press release and in our annual report on Form 10-K filed with the SEC.
We'll continue focusing on operating the rest of our company efficiently, but realistically, even with shifting many of our existing resources to focus on AI, we'll still grow our investment envelope meaningfully before we make much revenue from some of these new products. I think it's worth calling that out, that we've historically seen a lot of volatility in our stock during this phase of our product playbook, where we're investing in scaling a new product but aren't yet monetizing it. We saw this with Reels, Stories, as newsfeed transitioned to mobile, and more. And I also expect to see a multi-year investment cycle before we fully scaled Meta AI, business AIs, and more into the profitable services I expect as well.
Great. Thank you for joining us today. We appreciate your time, and we look forward to speaking with you again soon.
This concludes today's conference call. Thank you for your participation, and you may now disconnect.
Alrighty, so that wraps up the call. I mean, good, solid call. I don't feel like there was anything earth-shaking great or bad in the call, just to be quite honest. And I think that's why really the stock's about, after the initial comments, stock went down huge. And actually, I didn't even realize it went all the way down to 400 at the lows. Oh my gosh. I guess it held 400, but yeah, I mean, overall, it was kind of about everything I expected. The thing is, AI, Llama 3, all this stuff, it's huge. And it's going to be huge for Meta long term, but Wall Street doesn't really care about that right now. Wall Street, is obviously caring about booyah, is thinking about the next, 3 months in regards to stocks, 6 months, 9 months, right? And the bottom line is, guide came in weaker than analysts were expecting, slightly, right? And the bottom line is, spend is on the upper ranges. So it's pretty simple. Wall Street doesn't want to hold the stock right now. So we'll see. They might buy back soon. It's a pretty good gift, though. I'll say that for people out there. I mean, talking about forward P of low 20s with this sort of growth rate, 27% last quarter. Let's say they grow 18, 19% next quarter, 17% even. That's still extremely strong. And when you compare them against other stocks that have growth, in which Meta's growth outstrips many other companies, right? It looks pretty darn appealing and appetizing, right? So anyways, guys, appreciate you joining me as always. I think the biggest thing actually I took away from Meta earnings is it's impossible to not be a bit bullish on Nvidia. I mean, when you look at what Elon was talking about last night in the conference call, specifically mentioning H100, specifically mentioning Nvidia, specifically mentioned how many chips he hopes to have by the end of the year. When you hear Meta talking about big CapEx spend for the next several years, it all comes back to Nvidia. So I think if there's anything I walked away from, it's being more bullish on Nvidia than ever, just to be quite frank. So anyways, guys, appreciate you joining me. Thanks for joining me for this live stream here today. And I'll start preparing a main channel video. We're going to have a lot to discuss in that one.